Gold and silver are in free fall right now. Not slowly drifting, not pulling back, not consolidating. Free fall. As I'm recording this, gold just broke 4,600. Silver is at 72. And every few minutes I refresh my screen and the numbers are lower. 45.50, 45.20. It is not stopping. This is not a correction anymore. This is a crash in progress. A crash that is happening while you watch this video. Friday was supposed to be the worst of it. 38% down on silver, 16% on gold. The worst single day in 45 years. Everyone thought that was it. Everyone thought the selling was exhausted. Everyone thought the bottom was in. This is pure liquidation. Forced selling. Margin calls cascading through the system one after another. Traders being wiped out position by position, account by account. And it is accelerating, not slowing down, accelerating. Welcome to the hidden economy. If you are new here, I expose what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now because this is the kind of analysis you will not find anywhere else. And if you find value in this video, smash that like button. It helps the algorithm show this to more people who need to see it. Now, if you have watched my previous video, I showed you exact level of 117, why silver crashed from there. But at that time, people were commenting, look, it's going up 118, 120. But anyways, before I show you the data, this morning when market opened, thousands of traders tried to sell their silver ETFs, orders rejected, circuit breach. Friday's crash was so severe that today's prices are still below the circuit limit. The exchange will not accept sell orders. People who held through the weekend hoping to exit Monday morning are now trapped. They cannot sell at any price. The system will not let them. This is happening right now. As gold breaks through 4,500 and silver crashes through 72. This video explains why and how to make sure it does not happen to you. Here's what caused this. The weapon is called a margin hike. When you trade futures, you put down a deposit, usually around 10%. So if you want to control $100,000 worth of silver, you put down $10,000. That is your margin, your skin in the game. If the exchange decides to raise margin requirements overnight, you suddenly need more cash. Not next week, not when your transfer clears, immediately. If you do not have the cash sitting ready, your position gets liquidated. The exchange sells you out automatically at whatever price exists at that moment. And when everyone is getting liquidated at the same moment, the price at that moment is terrible. Rock bottom, the worst possible exit. One margin hike is survivable. Most traders keep some buffer, some cash on the side for exactly this situation. But what if there are 2 margin hikes? 3, 4? What if there are 8 margin hikes in 8 weeks? That is not survivable. That is extermination. That is exactly what the CME did. 8 margin hikes, 8 weeks. Each one designed to drain more cash from long positions. Each one tightening the noose. December and January, they hit traders with hike after hike. Christmas Day, hike. New Year's weekend, hike. Every time traders caught their breath, another hike. Then came the kill shot, January 13th. CME switched to percentage-based margins. Now when silver rises, your margin rises automatically. A trap that tightens itself. The higher silver goes, the more cash you need, even if you do nothing. And they did not stop after Friday's massacre. Monday morning, another hike. Then another one this week. 8 hikes total. For comparison, 2024 had 2 hikes the entire year. 2023 had 3. 2022 had 2. 7 hikes in 3 years was normal. 8 hikes in 8 weeks has never happened before. I went through 20 years of CME data. This is unprecedented. Each hike triggers forced selling. Forced selling pushes prices down. Lower prices trigger margin calls on other traders who were not even affected by the original hike. More forced selling, more price drops, a death spiral by design. That death spiral is what you're watching right now. Gold, 4,500. Silver, 72. And falling. But here's the part that kept me awake last night. This morning, same day as the CME hike, Shanghai Gold Exchange also raised margins. 20% to 26%. CME in Chicago, Shanghai in China, 14 time zones apart, same day, same action, same direction. America and China, these two agree on nothing. Trade war, sanctions. They argue at every international meeting, but on silver margins, suddenly they are moving in perfect lockstep. That is not supposed to happen. Unless they are both scared of the same thing. And I think I know what they are scared of. 356 to 1. That is paper silver to physical silver on the COMEX. For every 1 ounce of real metal in the vault, 356 ounces exist on paper. 1 real ounce. 356 paper claims. This works when everyone settles in cash. But when people demand physical delivery, the math explodes, and people are demanding physical delivery. In the 3rd week of January, 33 million ounces of silver walked out of COMEX vaults. Not traded, physically removed, loaded on trucks, gone, 26% of everything they had. In 1 week, 4 years ago, COMEX held 430 million ounces. Today, 113 million. 74% has vanished. And it is accelerating. First week of January, 7 million ounces left. Third week, 33 million. The exit is a stampede. Who is taking this silver? Not retail investors. Moving 33 million ounces requires trucks, security, warehouses. This is institutional money. Manufacturers, sovereign wealth funds, smart money. They are draining the vault before March. Here is why March matters. And this is critical. March futures represent 528 million ounces of promised delivery. That is how much silver has been promised to traders holding March contracts. The vault has 113 million ounces. Read those numbers again. 528 million promised, 113 million available. They have promised almost 5 times more silver than physically exists in the entire COMEX warehouse system. First notice day is March 27th. That is when every trader holding a March contract must declare their intention. Cash settlement or physical delivery. If just 22% of contract holders demand delivery, the vault is completely empty. Not tight, not stressed. Empty. What happens when the 23% shows up asking for their silver? This is the nightmare scenario that CME and Shanghai are desperately trying to avoid. This is why we are seeing coordinated margin hikes. They need to shake out longs before delivery demands expose the whole system. And it is working. Look at your screen right now. Gold 4,500. Silver 72. Longs are being exterminated. But here is the smoking gun. The evidence that tells you this is not a real crash. This is manufactured. Pull up 2 prices right now. While you're watching this video, COMEX silver. The paper price, the price you see on CNBC. $72 right now and falling. Now look up Shanghai silver, the physical price. The price where actual metal changes hands. $100. Same metal, same day, same planet, $28 difference. I need you to understand how insane this is. Paper silver in New York is trading at $72. Physical silver in Shanghai is trading at $100. That is a $28 gap. That is 39% higher for physical than paper. If silver was really worth $72, why would anyone pay $100 in Shanghai? Why would sophisticated Chinese buyers, manufacturers who need this metal for production, pay 39% more than they have to? They would not, unless they know something. They know the paper price is fake. They know $72 is a manipulated number. They know the real value of silver is closer to what they are paying, $100. And here is what should really bake your noodle. The gap is not closing. Friday, the gap was $25. Monday, it was $30. Today, even as COMEX crashes harder, the gap is still $28. Shanghai is not crashing with New York. Physical is holding while paper collapses. Think about what that means. If this was a real crash, a crash driven by actual supply and demand, both markets would be falling together. Paper and physical would move in lockstep. They are not. Paper is in free fall. Physical is holding steady. That tells you everything. The paper price is being pushed down artificially. The physical price is reflecting reality. One of these prices is a lie. And I think I know which one. Here is who benefits from that lie. JP Morgan holds the largest silver short position of any bank in history. Over a decade short. Every dollar silver drops, they make hundreds of millions. Bank of America, massive shorts. HSBC, massive shorts. These banks sit on CME committees. They have visibility into positioning. They know where the pressure points are. Friday, regular traders lost 38%. These banks made billions. Today, as gold crashes through 4,500 and silver through 72, they are making billions more. I am not alleging crimes. Short selling is legal. Exchange committees are legal. I am pointing out that the entities who profit most from this crash are the same entities with the most influence over exchange policy. Draw your own conclusions. The timing of last week also matters. Thursday evening, Reuters published a story claiming U.S. government ending support for strategic metals. Anonymous sources, algorithms triggered, selling cascaded. 3 hours later, Energy Department statement. Quote, the article is false and relies on sources that are misinformed or deliberately misleading. End quote. False. Completely made up. But markets had already crashed. Algorithms do not reverse for corrections. Also Thursday night, Kevin Warsh Fed chair nomination leaked. Hawkish. Bad for metals. Official announcement Friday morning. Insiders knew Thursday night. Fake news. Leaked nominations. 8 margin hikes. All in the same window. Coincidence? And here is something I found this morning that nobody's reporting. The day before the crash, Thursday, there was unusual options activity on silver ETFs. Massive put buying. Someone made huge bets that silver would collapse. The day before it happened. Either someone got very lucky or someone knew what was coming. Now here is what happened to traders who tried to get out. They could not. In China, the UBS SDIC Silver Fund was halted. Not slowed down, not restricted. Completely halted. Entire session. 0 trades executed. No buying, no selling. Nothing. Imagine watching silver crash 30% and not being able to sell. Clicking the sell button and nothing happening. Refreshing the page. Still nothing. Calling customer service. Hold music. Watching your net worth evaporate minute by minute while the exit door is locked shut. That is what happened to thousands of Chinese investors. In the US, ProShares Ultra Silver dropped 62%. If you had $100,000 Thursday night, you had $38,000 Friday evening. 62% of your money gone in a single session. iShares Silver Trust dropped 31%. Worst day in the fund's entire history since it was created. But the price drops were not even the worst part. Traders tried to sell. Orders rejected. Platforms showing error messages. Systems overloaded. Customer service phone lines with wait times over 2 hours. And when you finally got through, they told you there was nothing they could do. One trader messaged me saying he tried to close his futures position for 18 hours straight. Every single order rejected. Watching his account drain dollar by dollar, thousand by thousand, with absolutely no ability to stop it. As of last night, some traders were still reporting account access issues. Days later, still unable to see their balances. Still unable to execute trades. Still locked out. They crashed the price, then they blocked the exits, then they raised margins again. Think about that sequence. Crash, lock, raise. If you were designing a system to destroy long positions, to transfer wealth from retail traders to institutional shorts, this is exactly how you would build it. Now here's the fundamental picture that makes this crash even more insane. The crash makes no fundamental sense. None. Silver has been in supply deficit for 5 consecutive years. Solar needs it. EVs need it. AI chips need it. iPhones need it. Demand is exploding. Mine supply is flat. The cumulative shortfall since 2019 is 1.3 billion ounces. 18 months of global production. Gone. Consumed. And then China locked the door. January 1st, 2026. Silver added to strategic materials list. Export licenses required. Volumes down 40%. China refines 65% of the world's silver. They just told the West to find another supplier. There is no other supplier. And it is not just traders getting hurt. This crash is destroying businesses around the world. In India, in the jewelry trading hub of Rajkot, 44 firms have declared bankruptcy in the last week. Exposed. $425 million in losses. Exposed. Families who have been in the silver trade for generations wiped out. In London, 2 hedge funds have suspended redemptions. They cannot give investors their money back because their silver positions are underwater and they cannot sell. In Dubai, physical silver premiums have spiked to 15% over spot. Dealers cannot get enough metal to meet demand. This crash is creating wreckage across the entire global financial system. And we are only a few days in. Now connect the dots. 5-year supply deficit, exploding demand, China restricting exports, and the price is crashing. That only makes sense if paper is being manipulated down before March delivery. I think physical wins. I think it always wins. Paper promises can be printed. Metal cannot. But right now, paper is winning. Gold 4,500. Silver 72. Longs being destroyed. So what happens next? Where does this crash end? Nobody can tell you exactly where the bottom is. Anyone claiming certainty is lying. I am not going to give you price targets because in a crash like this, targets are meaningless. Support levels that should hold are breaking like glass. What I can tell you is what to watch for. Not price levels, something more important. The signs that tell you whether this is ending or getting worse. But here is what makes me think this is not the end of the story. And this is important. Shanghai Premium is not collapsing with paper. Physical buyers are still paying $100 while paper trades at 72. If this was a real crash driven by fundamentals, physical would be crashing too. It is not. Physical is holding. That tells you everything you need to know about what is real and what is fake. Lease rates are at 10%, 20 times higher than normal. Institutions are desperate for physical metal. You do not pay 10% to borrow something that is about to get cheaper. You pay 10% because you need it now and you cannot find it anywhere. Vault drain continues. Smart money is still taking physical delivery. 33 million ounces last week, probably more this week. While retail traders panic and sell, institutions are backing up the trucks. They are taking metal out of the system. March open interest is still elevated. Despite the crash, despite the margin hikes, despite everything, traders are still holding March positions. They still want delivery. They have not given up. The fundamentals have not changed, not one bit. The deficit is still real. The shortage is still real. China is still restricting exports. Industrial demand is still growing every single day. What has changed is the paper price. Only the paper price, pushed down through 8 margin hikes and cascading forced liquidation. At some point, paper has to reconcile with physical. It always does. Throughout history, every single time, physical reality wins. The only question is how much damage happens first? How many traders get wiped out? How low does paper go before the manipulation breaks? I think physical wins. I think it always wins. Paper can be printed infinitely. Metal cannot. That truth has held for 5,000 years. But here is what panicking retail misses. Crashes do not destroy wealth. They transfer it. Friday, wealth moved from retail to banks. When this reverses, it moves back. The question is which side you are on when it happens. Paper at 72, physical at 100. That gap closes eventually. Someone profits when it does. Here's what I am watching. These are the numbers that will tell you what happens next. The Shanghai premium, currently $28. This is the truth teller. This is the gap between what paper says silver is worth and what physical buyers are actually paying. If this gap widens to $40, paper is losing all credibility. If it narrows, because physical starts dropping, the manipulation thesis might be wrong. But if it narrows because paper rises to meet physical, that is when you know the game is changing. This gap tells you everything. COMEX vault levels. Every Friday they release the data. Last week, 33 million ounces walked out. If this week another 20 or 30 million leaves, the vault will be nearly empty before March. Who is taking this metal? Where is it going? Why are institutions paying for trucks and security to move physical silver while the price is crashing? They know something. Lease rates, currently 8 to 10%. Normal is 0.5%. This is what institutions pay to borrow physical silver. When lease rates spike like this, it means physical metal is hard to find. The last 2 times lease rates hit these levels were 1980 and 2011. Both times, something big happened shortly after. March open interest. How many contracts are still open for March delivery? If traders are capitulating and closing positions, open interest drops. If traders are holding despite the pain, open interest stays elevated. High open interest going into first notice day means delivery pressure. That is what the exchanges are trying to avoid. And trading halts, platform freezes, account lockouts. If more funds get halted, if more platforms freeze, if more traders report being locked out, that tells you the system is under stress. Functioning markets do not freeze. Stressed markets do. Shanghai premium, vault levels, lease rates. March open interest, system stress. Track these. The data tells you what is happening before anyone else figures it out. Shanghai premium widening means paper losing credibility. Lease rates spiking means institutions cannot find metal. Platforms freezing means the system is breaking. These are not just numbers, they are warning lights. Here is what I want you to understand about what you're watching right now. This crash is not random. It is not normal market behavior. It is not just profit taking after a big rally. 8 margin hikes in 8 weeks. Unprecedented. CME and Shanghai coordinating. On the same day, enemies moving together. Unusual options activity the day before the crash. Someone new. A $28 gap between paper and physical. Divergence that should not exist in an efficient market. Vaults draining at 26% per week. Smart money running for physical. Traders locked out of accounts, unable to exit. 44 firms bankrupt in India. Hedge funds freezing redemptions. Physical premiums spiking globally. This is not a correction. This is a coordinated attack on long positions designed to shake them out. Before March, delivery demands expose the fractional reserve nature of the COMEX. It is working. The attack is working. Longs are being destroyed. Right now, this minute. Gold, 4,500. Silver, 72. But the fundamentals have not changed. The shortage is real. The deficit is real. Physical is trading at 100 while paper trades at 72. At some point, this ends. Paper reconciles with physical. It always does. The question is whether you survive until that moment, whether you can hold through the pain, whether your stops got hit, whether your margin calls forced you out. That trader who messaged me Sunday night, he did not survive. He was right about everything, and he still got destroyed. Ask yourself tonight, do I understand my exposure? Do I have an exit plan? Is my position sized for survival, or am I one margin call away from losing everything? The winners in markets like this are not the ones who predict perfectly. They are the ones who survive, who manage risk, who stay calm while others panic. Survive until clarity, then act. This is not financial advice. Your money, your decisions. But if you're watching gold crash through 4,500 and silver collapse through 72, you need to understand what you're actually looking at. You need to see the full picture, the margin hikes, the coordination, the physical divergence, the vault drain. That is what this video gave you. The complete picture: gold at 4,500, silver at 72, Shanghai at 100. The gap is screaming. Paper and physical cannot stay this far apart forever. When it closes, someone will have bought at the bottom. Someone will have held through the pain. Someone will have seen what others missed. That could be you. Or you could be the trader who messaged me Sunday night. The difference is not luck. It is risk management. Drop your thoughts in the comments about this crash. Share this with someone who needs it. Subscribe. I'm covering this daily until it breaks. See you tomorrow.